Let's talk about the market and the bubble. Or again, we've been hesitant to use that word bubble when describing the current state of the market. But as valuations get more and even more stretched, I must say I believe we are now in bubble territory. And there's a lot of things kind of started to back this up here.
Yeah, and I would say before I kind of get into some of the numbers, I believe we talked about this last week a little bit on the show, but it's not even just the stock market. I mean, you talk about the real estate market being expensive. Maybe that one's not in a bubble, but it's by no means inexpensive. You look at the affordability index, it's pricey. You look at cryptocurrencies. I mean, obviously we've talked about that for many years now, and that to us makes no sense. I think there's a lot of similarities between a lot of cryptos out there and the pets.coms from the tech boom and then obviously the subsequent bust. I mean, there's just so many percolating issues out there that frankly makes no sense.
And actually in one of our posts, why the markets are hitting a new high, I think there we put in there too something about art.
Yeah,
art. I mean, there's so many things, and also M&A. I mean, there's so many things that there's these flashing lights out there saying, things don't look good, but yet you watch CNBC or maybe Fox Business and like, oh, there's rah-rah people on there.
Yeah, and I would say too, I mean, you know, we like to read Barron's. I think it's a great publication there. I don't agree with everything they say, obviously, but they do a roundtable, and this is the first time I can remember reading that roundtable, and pretty much every person there was concerned about the froth and the valuation in the market. And it was, again, just another sign of it's hard to find good things to buy for the long term because things have gotten so expensive. But just buying the market in the short term, the momentum, it's carrying things higher. It's like, oh, these guys don't know what they're talking about because, you know, I bought Palantir at the beginning of the year and I'm up so big. And, you know, I bought cryptocurrency, and it's like, good luck. I mean, yeah, you've been right for 7 months, but are you going to be right for 6-7 years? That's going to be the question.
And that round table, I think there's 7 or 8 managers in there, and they're all experienced managers. You know, they've got a good
different walks aligned, different strategies too. It's not like they're all value investors. I think there's 2 value investors, 3 value investors. There's some fixed income people. There's some growth managers in there. So I mean, you have differing opinions. And it was weird to kind of get that vibe that I got reading it. And I think the reason for this is, you know, obviously valuations. We talk about valuations. Valuations matter long term. But Apollo's chief economist, his name is Torsten Slok, released a graph showing the 12-month forward PE today versus where we were in 2000, other 5-year increments. The forward PE for the market as a whole is higher than it was back in 2000. But Torsten also raised further concerns that valuations for the top 10 companies in the index are now more stretched than during the height of the tech boom.
And these are things that, again, kind of stand out for us. We're kind of sharing them with you. And people say, oh, well, it's different this time. It's different this time. And I'm feeling like this is, and I went through the tech boom, and I was wrong for a long time. You don't know what day that day is going to close. But the thing is, you are now starting to be warned. And you may miss the very top. Maybe things go up another 2, 5, maybe 10%. I don't know.
Maybe 15. I don't know. Yeah.
But when it falls, people get the reaction like, okay, well, it's going to fall. It'll come back. It'll come back. And then before you know it, you're down 15%, 20%, 25%, 30%. Then you sell. It's like, gosh. And it's also off of a higher number. So your dollar loss is much bigger than your gain would be.
Well, and the issue, I mean, you bring up the tech boom, and I've brought up this point before, but, you know, Alan Greenspan is famous for his irrational exuberance quote. Yeah. That occurred in 1996, where he's saying markets were experiencing irrational exuberance. Well, again, 1996. It then went on for 1997, 1998, 1999. It didn't pop until 2000.
Yeah.
So, I mean, he was very early to that, but then the issue is, you wrote it out, and then you wrote, I'm going to pick on Cisco. You wrote that to 2000, and 2000, 2001, 2002. You lost 90% of your money. I mean, that is hard. And people are like, oh, 20% pullback. I'd be a buyer. Well, you get a 20% pullback, and it then drops a total of 90%. You would have lost so much money doing that. You have to be so careful buying the dip. And I worry that we could have something reminiscent of that. It's not going to exactly repeat itself. And that's a big thing I think people miss is we always say that history doesn't repeat. It rhymes. It's going to be, I think, similar, but not exact.
Right. And we used to do it at our workshops at 19 things to trading. And what happens is that when you start trading, it goes down. Okay, well, I better sell. And you might sell. And then it goes down, you buy more. And then it goes up. Oh, okay, I'm good. I'll buy more. Then it goes down. I mean, you get in this realm to where after 2 years, you've lost 80% of your money by trying to outsmart the market, and you're not going to do it. And the other problem too, Chase, is that considering these 10 companies now make up nearly 40%
Blows me away.
of the entire index. I can't believe when I saw that. And then making it even worse, looking at just the top 3 companies, which is NVIDIA, Microsoft, and even Apple's still in there. They now account for 20% of the index. So that means 497 companies account for 80%. I mean, it just makes no sense at all with what's going on.
Yeah, I mean, I think it's definitely gotten a lot riskier than people realize. And, I think I may have brought this up last week, but I think it is, again, pertinent to this conversation. But I heard this gentleman on CNBC that said, valuations don't cause bubbles to pop. And while that may be true, if you have, let's say, a forward PE of 30 on the S&P 500, we're not quite there yet, but let's say it was 30. I think once that catalyst comes and that pop occurs, it's going to be a heck of a lot worse than if the pop occurred at a valuation of 20.
Yeah.
So the issue is the larger and larger that balloon inflates, you're right. Maybe there isn't a catalyst that causes that big pop just yet. But again, the larger the inflation, I worry about the larger that pop.
And people say, oh, you just, wet blanket, you don't be part of the party and so forth. And it's like, no, I don't want to be the last guy at the party.
And I just really think people will invest in the S&P 500. And again, congratulations. You've done very well over the last 10, 15, 20 years. But you don't realize that 5-10 years ago, that index was, I'm going to say, a lot safer because it was more diversified. But I don't think a lot of people realize now the risk that they are taking by investing in the S&P 500 because they're looking at prior returns. And we all know that prior returns don't necessarily equate to future success.
And that's until they don't realize that as that goes higher in dollars, a 20% drop is a much higher decrease in dollars than the gain you got when it was $50,000. They just don't get that. And then they panic and their emotions kick in and they do that. So it's you've got to understand. And I don't recommend anybody invest in the S&P 500 anymore. It's just too expensive. Maybe it goes up a little bit higher, but it's just too expensive. I mean, it's just not a great thing in the S&P 500.
No, I think it's, again, a lot riskier than people realize.